Good afternoon, everyone. Welcome to this TradeStation webinar. Thank you for taking time out of your schedules and be here to learn a little bit about options. Our guest speaker today is Matt. Matt, welcome to TradeStation. He's
Thank
going
you
to join
very
us in just a
much for
moment.
having
Uh,
me. It's a pleasure to be
let's,
here. I had to unmute myself, but here I am.
Thank you, Matt. Thank you.
Yep.
We're going to do some intros and some disclosures before I pass the microphone over to Matt. So hang on tight for a moment. The title of today's presentation is Unlocking the Power of Iron Condors and Iron Butterflies in Your Options Trading Strategy. So Matt, of course, is going to highlight Iron Condors and Iron Butterflies and talk about their application in the markets and then some of the strategies around those two option strategies. We'll get to Matt in just a moment. My name is Jesus Nava. For those that don't know me, I'm the Director of Client Training and Education for TradeStation Securities. And we love doing these events to help you in your trading and give you some ideas, things to think about, especially in this topic, which is options trading, something that is risky, and we all need to be very careful when trading options. So here are some disclosures. Just keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation, and that active trading is not suitable for everyone, especially when it comes to options, which carry a higher degree of risk. Past historical performance is no guarantee of future results. And for additional information on these disclosures, go to www.tradestation.com/important-information. Another thing that I wanted to point out is that Matt Cashman is with the OIC. He's not affiliated with TradeStation. It's a pleasure to have him and benefit from his experience as a trader, as an educator. But as I said before, he's not affiliated with TradeStation. So nobody can do a better introduction to Matt Cashman than Matt himself. So I'm just going to go ahead and pass the microphone over to him. And one thing that I wanted to say before passing the microphone over to you is highlight some of the things that we're doing on TradeStation. I'm not sure if everyone here is aware of the Options Education Center. And let me just link this page right here in the chat so that everyone has access to this link. It is a place where we are creating articles, PDF, workspaces. These are TradeStation workspaces, also some custom studies, a lot of educational content related to options. Matt was with us a few months ago, and there's a webinar here as well on his past presentation. You're welcome to explore, go here and click on all the content cards that are available. I'm sure you'll find something that is useful. So thank you guys for joining us today. Let me go ahead and pass the microphone over to Matt and stop my share. Matt, the floor is all yours.
All right. Thank you very much. I'm going to give you, let's see, let's get my screen share going. Where did it go?
You see
That's
it?
not fun. Hold on a second. Hopefully that's it. How's that?
There we go. I see your
There
PowerPoint.
we go. Okay. Thank you, Jesus, for that. And thank you, everyone, for joining us today for the TradeStation and OIC or OCC webinar on the topic of iron condors and iron butterflies. My goal today is to give you a baseline understanding of the component pieces of these complex spreads and maybe give you a little bit of understanding of how the actual components work individually. And then we're going to put it all together and think about how they actually work as a giant complex spread, because both of these are actually complex spreads that have more than one leg built into them. So we're going to embark on this in a fundamental approach. We're going to learn these concepts, and hopefully my hope is that we're going to build up really a base level of understanding on how the spreads work, and then talk about how they work more holistically as condors and butterflies. As always, our goal here is to offer educational resources so that we can meet you where you are as far as your trading is concerned and help you to understand how these actual spreads work. I hope you find it useful and original and ultimately helpful in building your knowledge base surrounding options in general. So let me give a real brief background on myself. My name is Matt Cashman. I'm the principal of investor education at OCC. What that means is that I teach people how options work, basically. I have about 25 years of options trading experience, I started trading in 1999 in Chicago on the floor of the CBOE. I moved to London for about 3 years and traded German bonds there, and then moved back to the United States, where I started and ran an index options market making business again on the floor of the CBOE for about 15 years. In 2015, I wound that down and took a little bit of time off for COVID, and then came back to the marketplace as an educator. And so now what I do, I work at the OCC helping individuals and investors better understand how options work, both the risks and the benefits of exchange traded options. I always also include my own disclaimer, just like Jesus does for TradeStation. Options involve risk. They're not suitable for everyone. Anytime I discuss a strategy, it's strictly for illustrative and educational purposes. Please do not construe them as an endorsement, recommendation, or solicitation to buy or sell securities, etc., etc. About these trademarks, you're going to see them used wholly throughout the presentation. They are fully owned by the OCC. Now, a little bit about the OIC really quickly. Optionseducation.org is our website where we host an entire suite of options education. It is our entire purpose to essentially educate the public as to how options work. OIC is the Options Industry Council. It's the non-for-profit educational arm inside the OCC, which is the largest centralized clearing facility of options in the entire world. If you touch an option somewhere in the index or equity space in the United States, somehow along its life cycle, it goes through the hands of the OCC, either in the trading of it or in the settlement of it or in the exercise and assignment portion of its life cycle. OCC is the actual behind the scenes presence that keeps markets secure and moving smoothly through the option space. So we are the OIC inside the OCC as an educational arm. We have courses, podcasts, videos, and webinars that you can find at optionseducation.org. One other thing really quickly, options@theocc.com is an email address that goes to the investor education desk where I sit with 3 other colleagues. We answer options questions all day long, every single day from 8:30 in the morning until 4 o'clock in the afternoon. And this is a fantastic resource that's, to be honest, doesn't get taken advantage of by the public enough. Send us email questions about options. It's important to understand we're not registered investment advisors. So we can't help with, whether or not you should sell your call spread or not. But what we can help you do and what we really excel at is to be able to educate you as to how the call spread works more generally, and then allow you to use that education to make a decision that better aligns with your investment objectives. So all of that out of the way, let's get right to what we're going to talk about today. I always start every presentation that I do with this slide, which is annual options volume cleared by OCC on an annual yearly basis going back to the year 2000. Obviously, you can see it's from bottom left to top right. It's going up, 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 up. So last year we cleared 12.3 billion contracts. That's billion with a B. Most of the growth in the volume in the options business has been over the last 5 years. It started with COVID. Lots of people have varying opinions as to why that is. I think it's a confluence of events. We were all inside, we were all on our couches, and there was zero cost brokerage platforms that were available and stimulus checks that were also available. Lots of people got involved into a marketplace in options starting in 2019 and 2020 when all of that happened. And what we have seen since then, I think, is that people who have entered that marketplace have understood that options are incredibly flexible and useful instruments. The thing that's important from my perspective as an educator is that you also understand options are leveraged instruments and that they're not necessarily for everyone. So that's the reason why I put this slide in at the beginning of every presentation, is to give you an idea of 2008, the great financial crisis. We did 3.7 billion contracts total at OCC. And last year we did 12.3. So there's been an exceptional amount of growth in this business. I need to make sure from my educator seat that people understand how options work when they go in and start trading them. So with that said, let's get right to what we're going to talk about today. We're going to talk about vertical spreads. Why are we talking about vertical spreads? Because they are the building blocks of iron condors and iron butterflies. Vertical spreads are the two things that you can put together that will create these strategies. And the more you understand about these vertical spreads, the more you're going to understand holistically how the spread, the condor, works more specifically. Those two spreads that we're going to talk about specifically are call credit spreads and put credit spreads, because those are the two pieces of the iron condor that when you stick them together, you get the actual iron condor. We'll talk about how the pieces work individually. We'll put them together into the iron condor, and then hopefully we'll have some time for Q&A at the end. So let's start right from the very beginning. Spread transactions. A spread involves two or more positions. It's a pretty simple concept. However, it can get a little bit more complicated when you start to think about what it actually does, because you're really buying or selling one option and you're buying or selling another option. If you're buying one option and it's a spread, generally speaking, you're going to be selling the other option, or the opposite, selling one option and buying the other option. Now, likely these two options that we're talking about are on the same underlying. So they're two options on the same underlying, meaning the same stock or the same index or the same commodity. Likely they have the same expiration dates. That's not always the case, but most of the time, especially for things like iron condors and iron butterflies, they're generally having the same expiration date. They have different strike prices, and sometimes they have different quantities. Although with the strategies that we're talking about today and the examples I'm going to give you, we're talking about doing them one by one by one by one. And so we're going to talk about what it looks like when you have a one lot of iron condors is one spread and one spread. So it's four options, but it's one spread versus one spread. Occasionally you can trade spreads that have different quantities. Some of those are what I would call 1x2s or 1x3s, 1x4s, 2x3s, like all kinds of things. You can get as complicated as you want to be honest. And many times when you're a professional options trader, you do a lot of that trading because that's where some of the actual options flow is coming in. When you're a market maker, people like to trade 2x3s and 1x2s and 1x4s, things of that nature. But for our purposes today, we're going to talk about one-up spreads. Spreads can also involve stock positions. So things like what we call married puts or protective puts, and what we also call buy rights. Buy rights are long stock positions and short upside calls together as one spread. That's usually talked about as something called a buy right. And then what I said earlier, those married puts or protective puts are long stock again, but with a long downside put against it. So protective puts are long optionality and covered calls are generally short optionality, because on the protected put side, you're buying puts, you're buying the option and you're long the stock. On the actual covered call side, you're selling the option, you're selling that call and you're long the stock. But spreads can also involve a stock position. Let's talk about vertical spreads a little bit more specifically. You're buying one option and you're selling another, just like we talked about the spread in general. It's the same underlying and expiration, but it has different strike prices. Because of the fact that it has different strike prices, and especially if you're doing them one up, one by one, you have what we call defined risk reward characteristics. What does defined risk reward mean? It means that you don't have open-ended risk. For instance, if you are just selling options, if you're just selling one option and that's all you have on, you have what we would call open-ended or unlimited risk. When you're trading spreads like this, when you're long one option and short another option, you have defined risk. I'll show you what that means from a P&L perspective, a profit and loss perspective, when we get a little bit farther on. But the two main types of spreads, we have debit spreads, both calls and put debit spreads, and we have credit spreads, both calls and puts credit spreads. Now, what's the difference between them? Well, one of them is a debit and one of them is a credit. What does that mean? Well, the debit spreads means that you're paying premium, you're paying money to initiate this position. Oftentimes, what that means generally is that the option that you're buying is more expensive than the option that you're selling. So, for instance, if you're buying an option that's worth $4 and you're selling an option that's worth $2, The spread that you are creating is a $2 spread because you're paying $2 net for that actual spread position. But you would also have on what we would call a debit spread because you were paying for that spread. Credit spreads are the exact opposite of that. You're receiving premium to initiate this position. So in the example that I just gave you, that very general example of buying a $4 option, selling a $2 option, in this case with the credit spread, you would be selling the $4 option and buying the $2 option. Thus, the amount of premium that you are selling or taking in your account is more than the amount that you're paying out for the long option. And so you would have what we call a credit spread. Both of these spreads have defined risk characteristics. One of them is long optionality, the debit spread, and one of them is short optionality, the credit spread. Depending on where the stock is, as far as the strikes are concerned, debit spreads can turn into credit spreads and credit spreads can turn into debit spreads, depending on where the stock is. Generally speaking, with the stock closest to a strike where you are short options, you're probably going to have on what we would call a credit spread, meaning the option that you're short is going to be bigger than the options that are farther away that you're long against it. And the opposite of that is also true. So that can be a little confusing for people when they're just diving into this. But what I want you to think about initially is just the debit spread is the spread that you are actually paying money for, and the credit spread is a spread that you are actually receiving money to put on. So, sorry, my video is a little wonky. Okay, let's talk specifically about the call credit spread, because I think that's really where we're going to dive into the pieces of the actual condors and butterflies. So why would you want to put on a call credit spread? Generally speaking, the investor who's putting this on has the motivation of being either neutral or bearish. They want the defined risk characteristics of the spread. They want that favorable break-even point. We'll talk about that in a moment, because the credit that you receive when you put these spreads on moves your actual break-even point relative to the actual position itself. And they're looking for profit potential that's heavily influenced by the amount of credit that you receive. In this case, when we say heavily influenced by the amount of credit that you receive, that basically means your profit potential is based on how much premium you're taking in when you're selling these spreads. So selling a larger spread, a spread that has more premium in it, sometimes can create more profit potential. It can also have the commensurate amount of risk that goes along with it. Always keep in mind, in the options world, just like in any other part of investing, you can't get anything for free. Risk and reward are often two sides of the same coin. Don't ever think that you're going to be able to sell something for a ton of premium without potentially incurring more risk than you normally would if you were selling something for less premium. So the risk control aspect of this has defined profit potential, defined maximum loss. And the other part about this, when you're talking about risk control, when you have spreads on, is that monitoring these positions is really critical. What I said when I was discussing credit spreads and debit spreads and how they can sometimes transfer into each other based on where the stock is relative to the strikes of those spreads, that's what this is talking about. Position monitoring is critical. When you put on one of these spreads, if you put on one of these spreads and you do it for a specific reason, it's important that you continue to monitor and think about whether or not the reason that you put this spread on still exists. Is this still the position that I want to have on? Because oftentimes what will happen is you'll put a spread like this on and then the stock will move. So a lot of the time that people put these spreads on, they're constantly moving them around and trading in and out of these spreads as the stock moves. For instance, if you want to always be short the 25 delta, 10 delta call spread, the delta of those two options, if the stock moves down 2 standard deviations, is going to change significantly. and your option position is going to stay where it is. You're still short this strike and you're still long this strike. However, those two deltas of those options has changed a lot because the stock is now trading down here somewhere, down 2 SDs. And so this delta, the 25 delta that you were short and that you decided, I really want to be short the 25 delta option and long the 10 delta option, those options don't have the same delta characteristics anymore. That's what we're talking about when we're talking about position monitoring being critical. Always think about, like, does this spread have the same characteristics that I wanted when I first put it on? Because spreads change over time and they change with movement in the underlying. Let's look at a real world example of a call credit spread. Stock XYZ is trading 88.5. You have 28 days to expiration. These are 28-day options. So like a month out options. We're going to sell the 90-95 call spread. The 28-day 90 call is worth $3.50. We're going to sell that option and we're going to buy the 95 call, which is worth $1.80. The net credit of this spread is $1.70. So when you zoom out, I would look at your position after you put this on and I would say, okay, great. You are short the 90-95 call spread. Why are you short the 90-95 call spread? Because you're short the 90s, which are a larger option, and you're long the 95s, which are a smaller option. Because of this, you have this on for net credit. Always keep in mind, when you sell optionality or when you sell premium, the actual money that creates goes into your account and stays there no matter what. What ends up happening is that if you were to sell this for $1.70, the $1.70 that goes into your account stays there, and both of these options actually mark on a day-to-day basis. So while this one was worth $3.50, tomorrow it might be worth $4 or $3.70, or it might be worth $3, depending on where the stock goes. And this call, this 95 call, is also going to move around. And so what you get is constant end of day, what we call mark prices. So while this spread may be worth $1.70 today, if the stock goes down, tomorrow it might be worth $1.50. Or if the stock goes up, the next day it might be worth $2. It's always going to be the difference between where this 90 call marks and where this 95 call marks. In this case, because you're short the larger option, and these are calls, this is what we would call a neutral or a bearish spread. This spread is going to theoretically go down in value when the stock goes down, because calls are positively, generally, they are positively correlated to underlying price, meaning when the price of the stock goes up, generally speaking, call prices go up. And when the stock goes down, generally speaking, call prices go down. Because you are short a larger option and long a smaller option, you are what we call short the 90-95 call spread, which means as the stock goes down, the spread is probably going to decrease in value. Now, 88.5, the stock is trading 28 days to expiration. You have sold the 90-95 call spread, like we said, for $1.70. Your maximum gain from this is $1.70. This is that defined risk and reward characteristic that we talked about that spreads have. The most you can make on this is $1.70 because you sold it for $1.70, and if it goes out worthless, you keep all $1.70. The maximum risk is $3.30. Now, why is the maximum risk $3.30? The maximum risk is how much you collected for selling this spread minus the difference between the strikes. I'm going to say that again. Your maximum risk when you're short a call spread like this is the amount you collected when you sold it minus the difference in the strikes. Now, why is that? The reason why is because the most this 90-95 call spread can be worth is $5. The most that call spread can be worth is $5. Why? Because the difference in the strikes is $5. If both of those calls are fully in the money, the 90s are going to be worth $5 more than the 95s. If the stock's trading 130 at expiration, the 90s are going to be worth $40 and the 95s are going to be worth $35. And that's going to be the actual most that spread can be worth. So your max risk here is the amount that you sold it for minus the difference in the actual strikes in the call spread. Because of that, your margin is generally calculated as your maximum risk, or $3.30. And your break even here is going to be 91.70. Why is your break even 91.70? Because remember, when you sell this call spread, that $1.70 goes into your account. So to calculate your break even, you're going to add that $1.70 to the lower strike because it's a call spread. So your break even is the amount at which, if the stock settles 91.70 on expiration or lower, you're going to make money. If it settles 91.70 or higher, you are probably going to lose money on this spread if this is the only position that you have on. Now, what is this spread worth with the stock trading 88.5 in 21 days or in 7 days? This actual question is meant to kind of breach the subject of what we call theta or decay. Generally speaking, options, because they have a life cycle, they have a date that they are listed, which is the beginning of their options life cycle, and they have a date where they expire, which is the end of their options life cycle. When you're trading stock, an underlying stock, if you're just trading delta or stock, your positions don't necessarily have an expiration date, because you could hold stock forever if you wanted to. As long as that company is still in business and the stock trades, you can hold that position as long as you want. You can't hold option positions forever. Why is that? Because they have an expiration date. At some point in time, depending on that option is going to not exist anymore. It's going to expire. Well, because of this, you have a limited number of days that life cycle includes for that option. What that means is that each day that option is alive has a certain amount of theta or decay in that option. Options generally over time become worth less and less and less and less because of the actual time of their life cycle is shortening and shortening and shortening. So in this case, with the stock trading 88.5, if nothing else happens, this spread that you put on for $1.70 is probably going to be worth less than it is now in 21 days and less in 7 days than it is right now because of the forces of theta. If you want to talk about theta, which is a Greek, take a look at optionseducation.org. We have a ton of information about all of the Greeks, including theta, which can be very helpful. Now, let's take a look at the actual P&L of what this looks like when you sell credit spreads. Remember, we're selling the 90s and we're buying the 95s, and they're both calls. This is a call credit spread. The net credit of this is $1.70. Remember, again, when you sell spreads, that premium amount goes into your account and stays there. The actual options mark on a daily basis. So they might mark as negative P&L or positive P&L in between the time that you actually put the trade on, the time it expires, but the actual premium that you sell stays in your account. Let's look at the actual P&L of what this looks like. Your max profit is $1.70. Remember, we said the defined risk reward characteristics of spread means when you sell it for $1.70, that's the most that you're going to or could make on it. That means that below 90, the stock finishes below 90 and both of these options go out with zero value or worthless, you get to keep the $1.70. What does that mean? It means that your max profit is $1.70, which is this area of the P&L curve. If the stock goes out above 95, both of these options are going to be in the money, and thus the actual spread is going to be worth its maximum amount. What's the maximum amount it could be worth? $5. Well, why is this only $3.30? Because remember, the spread's worth $5, but you collected $1.70 when you sold it. So the max loss here is $3.30. That's if the spread goes out worth $5. In between there, you get this kind of diagonal P&L line where your break even crosses the zero bound at 91.70. Remember what I said, 91.70 is the break even here. If the stock finishes below 91.70, you are likely going to make money on this spread. If the stock finishes above 91.70, you are likely going to lose money on this spread. Now, what happens at expiration? This is the real actual question here, because this is where the rubber meets the proverbial road. You can go sell that spread and hang out and do nothing until expiration, but at expiration, something's going to happen because, like I said, that option turns into something else at expiration. Generally speaking, either the option expires worthless and it turns into nothing, or if it's in the money, oftentimes it will turn into an underlying stock position. If the stock is below 90, remember, you sold the 90 call and you bought the 95 call. If the stock is below 90, you sold this for $1.70, and both of those options go out worthless, and you get to keep the $1.70. However, if the stock is really close to 90, you have a little bit of uncertainty as to whether or not you're going to be assigned on the short 90 call. If you get assigned on the short 90 call, you would have a resultant short stock position after expiration. Because when you're short options, you incur the liability of making those options whole if you get assigned on them. Here's something that's really important to understand about expiration. If you're short an option, you have the ability to be assigned on it. You incur the liability of making that contract whole. If you're long that option, you actually control the right to exercise that option and thus create a long or short stock position based on what kind of option it is. If it's a call, you have the ability to create a long stock position. If it's a put, you have the ability to create a short stock position or to sell the stock, because of the fact that calls are the right to own stock and puts are the right to sell the stock. Now, if the stock finishes below 90, both of these options are going to be going out worthless. If the stock finishes above 95, both of these options are theoretically going to be in the money, and you would incur the maximum loss on this spread, which again is 330. It's the difference in the strikes minus the premium that you receive. Generally speaking, your short 90 call is going to be assigned, so you're going to have a short position in the stock. But you can also, remember, if you're long the optionality, which you are in this case on the 95 calls, you have the right to exercise that and create a long stock position. In this case, you would probably be assigned on your 90s, which would create a short stock position. And then you would exercise your 95s, which would create a long stock position. Both of those would cancel out, and you would have a zero position. That is where the actual defined risk comes from. Because in a spread position, you actually are short and long optionality. And remember what I said, it depends on where the stock is, depending on whether or not you have a credit spread or a debit spread on many times. And the reason why is because if you're short the 90s and you're long the 95s and the stock is down here in the 85 range, both of those options are worth nothing at expiration. But if the stock is trading 100, both of those options are going to be worth a lot at expiration. And it's going to be the difference between those two options that is going to actually create the max loss on that spread. And you're going to have to think about exercising these 95s to counteract the assignment on the 90s. Now, things get complicated a little bit when you are in between the 90s and the 95s. Sometimes what can happen here is that your short call gets assigned on the 90s, and your short stock, which would require a little bit of margin, and your long call, the 95s, might expire worthless. If you're in between here, in between 90 and 95, you have to monitor this spread because of the fact that you need to understand what your stock position is going to be after expiration. If you get assigned on the 90 calls, you are going to have a short stock position. And while you do actually maintain the right to exercise your 95s, what that means is that you would be buying stock at 95. If the stock's trading 91, you don't really want to buy stock at 95 because you might be able to buy the actual stock cheaper in the open market at 91 and be able to buy the stock back that you're short from the 90 call being assigned without having to exercise that 95. Oftentimes, when the stock goes all the way through these strikes up here at like 100 or 110 or 120, that's when it's like, okay, well, I'm getting assigned on my 90s and I'm going to punch my 95s, meaning I'm going to exercise my 95 calls because both of them are way in the money. And it doesn't really matter because the stock is trading so far out that the actual call spread is worth the most that it can be worth any. However, when the stock's trading like 91 or 91 quarter, it gets a little bit dicey in here. You need to pay attention to whether or not you're getting assigned on these 90s and pay attention to what your stock position is going to be after the actual expiration. Okay, So that's the call credit spread. That's building block number 1 of the iron condor or the iron butterfly. Now we're going to talk about the exact same thing, but on the put side. The other component of these complex option strategies is the put credit spread. The dynamics work exactly the same on the put side as they do on the call side, but in the opposite direction. So let me give you some explanation as to how these motivations might work and why people put credit spreads on. Oftentimes, put credit spreads are neutral or bullish, which is different than the call credit spread. Remember, call credit spreads, people generally put them on when they are neutral or bearish, because call credit spreads work on the way down generally. Remember, calls are positively correlated to underlying price. So when the underlying price is going up, calls are generally going up. Puts are the exact opposite. They're negatively correlated to underlying price. Hence, if you're putting a put credit spread on, from the investor's back-end perspective, you are either neutral or bullish, because that spread is going to go down in value when the stock goes up, because it's negatively correlated. Now, the other parts of this are exactly the same. It has defined risk and reward. The favorable break-evens will exist from the credit that you receive when you sell this spread. And your profit potential is very heavily influenced on the amount of credit that you take in when you sell it. The other thing that is exactly the same are the risk controls. They have defined profit potential in the put credit spread. We'll look at that in a moment. Defined maximum loss. The same exact math applies. The difference in the actual strikes is the most the spread can be worth. And the position monitoring, again, is very critical for the exact same reasons that I just gave you on the call credit spread, except on the put credit spread in the opposite direction. Let's look at a real world example here to drive this point home. Again, same stock, 88.5, same amount of expiration, 28 days to expiration. Now we're talking about the 80-85 put spread. So in this case, the 85 puts are trading 205, the 80 puts are trading 70 cents. You sell the 85s, the larger option, and you buy the 80s, the 70-cent option. Your net credit for this is $1.35. Remember, again, when you sell optionality, the credit goes into your account immediately and stays there. Those options are going to mark different prices every day, and the spread may change in value every single day, but that credit that you created when you sold this spread stays in your account. Again, if you sold this spread and then showed me your position, I would look at this and say, great, you're short the 80-85 put spread. Good job. You're short the 80-85 put spread. Now, what does that mean? It's a neutral or a bullish spread. Like I said, that's the reason why people are going to put this on. Generally speaking, downside put spreads, which is what this is, right? Both of these strikes are lower than where the stock is trading. That's how we define it, as like a downside put spread. The 80-85 put spread is probably most of the time going to go down in value when the stock goes up. Hence, it is a neutral and or a bullish spread. Let's look at the actual spread example. Again, selling the 80-85 put credit spread at $1.35, your maximum gain is what you sold it for. That's the most you can make on this. If both of these options go out worthless, your spread that you sold for $1.35 goes out for $0, and you get to keep the $1.35. Your maximum risk is $3.65. Again, why does that number exist? What's the most it can be worth? Most the spread can be worth is the difference in the strikes. You take the difference in the strikes minus what you actually sold the spread for and collected in your account, you get $3.65. That's your max risk. Again, your margin is going to probably correlate very closely to your maximum risk, and thus your break even is 83.65. Why is it 83.65? When you sell a call spread, you add the premium that you take in to the bottom strike to get your break even. When you sell a put spread, you actually subtract it from the top strike. So 80-85 put credit spread you sold for $1.35. Your break even to the downside is the upside strike 85 minus $1.35, 83.65. We'll get into that in just a moment. Again, the question is, what is the spread worth in 21 or 7 days? Remember, options have a life cycle that includes an expiration date, and thus they have what we call theta or decay. Options individually have theta, and spreads have theta. Why do spreads have theta? Because the actual spread theta is just the theta of one option minus the theta of the other option. They're both decaying, but one of them might decay at a different rate than the other one. And so spreads have different kind of risk characteristics that are built in, but the actual risk characteristics of spreads just come from the combination of the two options and their individual risk characteristics put together into one. Let's talk about what it looks like from a P&L perspective. Remember, you sold the 85 put, you bought the 80 put. That's 205 for this put and 70 cents for this put. You're collecting a $1.35 total. So the most you can make on this, your max profit is 135 bucks or a $1.35. That's if the stock goes out 85 or higher. Stock goes out above 85, both of these options are going to expire without value. Now, what does it look like on the max loss side? That's if the stock goes out below your bottom strike and both of these options are in the money. In that case, how much is this option spread worth? It's worth the difference between these strikes. It's worth $5. If it's worth $5 and you took in a $1.35 to begin with, your max loss is $5 minus a $1.35 or $3.65. If the spread goes out full value, $5, you're going to lose $3.65 on this. Where does it go full out? Where does it go out full value? If the stock finishes below the bottom strike. Now, this is the point that gets a little funky in here is in between these two strikes, your break even is 83.65. Remember, it's the 135 below that 85 strike, which is 83.65. That's your break even to the downside. The stock goes out below 83.65. You're probably going to lose money on this spread. If it goes out above 83.65, you're probably going to make money on this spread. Same dynamics exist at expiration in the opposite direction. Stock goes out above 85. So there's three real possible ways this can happen, right? The stock can go out above 85, it can go out below 80, or it can go out somewhere in between. If the stock goes out above 85, remember, you collected a $1.35. Both of these options go out worthless, and you collect and keep the $1.35. That's what this part of your P&L curve looks like. Above 85, both of these puts go out worthless. Assignment risk here is if the stock goes out close to 85 and you're not sure whether or not you're going to be assigned on the 85s. If you are assigned on your 85s, you are going to be long stock, not short stock. Why? Because remember, you sold that put to someone else. And that put is the right to sell stock. So if that person exercises the put and decides they want to convert that long put that they bought from you into a short stock position, your job is to make that position good. How do you make a short stock position good? You have to buy the stock. And so when you're short puts and you get assigned, you actually end up with a long stock position. That's why the P&L graph looks the way that it does right here. So you need to pay a close attention if the stock is close to that short strike as to whether or not you're going to be assigned. But let's look at what happens if you are actually below 80. Remember that the stock goes out below 80. The spread is worth the most that it can be worth, which is the difference in the strikes. Both your 85s and your 80s would be in the money. You would most likely get assigned on these 85 puts, meaning you would have a long stock position at 85. You would also have the ability to exercise your 80 puts, meaning you would have a short position at 80. And so you would have the difference between those, or $5 of difference here, which is why the spread is worth $5. But you would have no stock position if you got assigned on the 85s and you exercised your 80s. But you would incur maximum loss. 135 is what you collected for it. The spread itself is worth $5. You would be buying stock at 85 and selling it at 80, essentially, through the actual conversion of your options. And so you would be out $3.65 below 80. Now, again, the same thing is true here. Between 80 and 85 is where things get a little wonky around expiration. You have to pay attention to whether or not you're going to be assigned on these 85 puts. Because if you get assigned on 85 puts that you're short, you're going to be long stock. You need to remember that and pay attention to that. This exists even when you have the entire iron condor on, which we're going to talk about in a second. The call credit spread and the put credit spread, when you put them together, create the iron condor. The reason why I teach these individually is because I want you to understand how the call credit spread works and how the put credit spread works, so that we can put them both together and think about the dynamics of the risk holistically as one full position. But the put credit spread looks exactly like this. Keep in mind, when you look at this chart, all you have to do is flip it around, and it's the exact same chart the opposite direction with the call spread, with the call credit spread. It has defined risk, it has defined reward, and it has this kind of like in-between area between the two strikes where things can get a little wonky at expiration. That's true when you have both the call credit spread and the put credit spread on at the same time. It can happen in both directions. So it's important that you understand the dynamics of those spreads and how they work when you're going to start to think about them as iron condors. So with that said, we understand the building blocks of how these spreads work. Let's talk about the actual iron condor. So there are some investors who believe that a stock is not going anywhere, that it's going to stay right where it is, and they are neutral on this stock. They're looking to benefit from a situation without any weird, unexpected movement outside of the boundaries of where they think the stock is going to be. This is when people like to put on, generally speaking, iron condors. Why do they like to put that on? Well, think about what I talked about. The call credit spread has a defined risk characteristic, but it also has a defined outcome and an expiration date. With that expiration date comes a life cycle that includes theta. That means if you're short that call credit spread and time is passing and nothing is happening, the spread is probably going to be lowering in value, decreasing in value, and you're going to be making money on that. If you have that on the call side and the same thing on the put side, and you're short both of them, theoretically, if nothing is happening, both of those spreads are going to be coming down in value. By how much? By their theta amounts on a daily basis, because they both have expiration dates that are approaching rapidly. Each day that goes by is one day of their life cycle that is taken out of that equation. So many people use iron condors when they think nothing is going to happen. So what is an iron condor? I kind of teased this a little bit before. It's basically just the call credit spread that we talked about originally. That's your P&L graph of the call credit spread. Remember what we looked at there, right? Short the 90s, long the 95s. Those are out of the money calls, along with the sale of your put credit spread, the 80-85 put spread. We talked about this one. We talked about this one. What does it look like when you put them together? The same underlying, the same expiration month, both spreads employing out of the money options. Remember, we talked about this stock is trading 88.5, which is like right here, and 88.5, which is like right here. These are out of the money call spreads and out of the money put spreads. So let's look at what it looks like in real world terms. We're going to just take both of those spreads and put them together. 28 days to X, the 88.5 stock, expected price range. You think maybe this thing's going nowhere. It's going to stay between 85 and 90 during the entire time. So what am I going to do? I'm going to create the 80, 85, 90, 95 iron condor. That is all that we are doing, is selling the call spread and the put spread together at the same time. We're putting them both together. Remember those prices that we use. The call credit spread traded $1.70. The put credit spread traded $1.35. Since you're selling both of them, you're collecting premium on both of those sales. And so your net credit is the credit of both of them combined. So instead of just collecting 170, you're just collecting 135. You're actually collecting 305. However, remember what I said earlier, which is risk and reward are two sides of the same coin. You oftentimes cannot get one without the other. You can't sell this thing for twice as much as you would sell its individual parts without incurring a little bit more risk. Well, what's your risk here? Your risk is that you have defined risk in both directions. So whereas if you were just to sell the call credit spread, you would have defined risk to the upside. And if you were just to sell the put credit spread, you would have defined risk to the downside. Now you have both of them on. You have the call credit spread and the put credit spread. So what do you have? You have defined risk in both directions. This is how you construct a typical iron condor. Iron condors are typically out of the money put spreads and out of the money call spreads, either selling or buying both of them. You can do it either way. We're going to look at the sell side of it because that's generally how people actually use them. So let's look at the example a little bit more deeply. You're going to be selling the 80-85 put spread and the 90-95 call spread. The total premium you're taking in is 305. So utilizing the same idea that we had when we were talking about the spreads individually, you're going to do the exact same thing here. Your maximum gain, because you have defined risk characteristics in both directions, you also have defined gain here, maximum gain. That is the amount that you sold these spreads together for is 305. That's the most you can make. If the stock goes out in between these strikes and nothing happens, you collect and keep the amount of premium that you sold for this strategy. Your max risk is 195. Why is your max risk 195? The spreads individually can be worth the difference in their strike prices. But I want you to think for a moment about how these spreads work and the fact that one of them is positively correlated to underlying price, and one of them is negatively correlated to underlying price. Because what that means is that if you sell both of these spreads at the moment of expiration, both of them cannot be in the money. One of them might be, but there is one definite thing that I can guarantee. At the moment of expiration, both the out of the money call spread and the out of the money put spread cannot be in the money at the same time. So with that being said, your max risk is that one of these spreads is worth its maximum amount, which is $5. So in this case, what you end up with is 305, the total amount that you collected when you sold it, minus $5 as your total risk, gets you to your max risk of 195. Now, your margin is probably going to be commensurate with your maximum risk, and your break evens are going to be your top strike plus the 305 that you sold in the call spread, right? The 90s plus the 305 that you sold in premium. And then break even to the downside is going to be your upside strike 85 minus the 305 or 81.95. Now, what does this look like from a P&L perspective? It's going to look like a combination of the call spread and the put spread together. I'll give you a little preview of what it's going to look like. It's just going to be the 90-95 call credit spread that we initially looked at. I want you to think about what that looked like from a P&L perspective. And the 85-80 put credit spread for a net credit of 305 total. If you put those two things together, what you get is this. So let's break it down. This side is your put credit spread. Remember what it looked like. If you just take this part of the graph and you forget about all of this over here, this is your 80-85 put credit spread. And this side is your 90-95 call credit spread. You have sold the 90s, sold the 85s, and you have bought the 80s, and you've bought the 95s. Defined risk and defined reward. In this case, what does that mean? That means this is the most you can make, 305, because you sold this put spread and you sold this call spread. So the most you can make is the total amount that you took in if absolutely nothing happens between now and the time that everything expires. The most you can lose is the total amount you took in minus the difference in the strikes of one of these spreads. So if this spread goes out worth $5, you're going to lose 195 because you collected 305 and the spread itself is worth $5. If this spread goes out worth $5, you're going to lose 195. That's why this P&L looks this way over here, because you've collected 305 and the spread's going to be worth $5. But what I can tell you for sure is that this spread and this spread cannot both be worth $5 at expiration because of how they work. One is positively correlated to price, one is negatively correlated to price. The put spread, the out of the money put spread and the out of the money call spread cannot be worth $5 at the same time at expiration. Now, here is your risk. The risk of this position is obviously what we talked about. Here you have defined risk to the downside below 80, and you have defined risk to the upside above 95. But the other risk of this is that while the actual position is on, let's say it has 28 days. We use 28-day options to give you an idea of what this looks like if you do this for a month-long option position. Let's say every day between the time you put it on and the time that it expires, the stock is all over the place and it's moving around and it's like whipping around and it's doing all kinds of crazy things. It's trading 80 and then it trades 92 and then it trades 95 and it trades 105 and it trades back to 90. Your risk here is that you're going to be in a situation where it's going to look pretty bad between now and the time that it expires at certain points on this curve. And many times when people put iron condors on for that very reason, they will move these iron condors around. They'll do what we call rolling iron condors. And they roll them to constantly be in a situation where they're constantly short the out of the money put spread and the out of the money call spread. What that means is that the stock's trading 88.5, which is what we talked about. The 80-85 put spread is the out of the money put spread, and the 90-95 call spread is the out of the money call spread. But if the stock goes up to 90 and then it goes to 95, you're not short out of the money call spreads and out of the money put spreads anymore. You're short in out of the money put spread, but you're short in the money call spread. And so oftentimes what people will do is they'll actually roll this from the 80, 85, 90, 95 iron condor. The stock goes up to 95. They might have the 85, 90, 95, 100 call condor. But what that means is that you have to close this position and open the other position. Now, many times, if that's what you're looking for, if you always want to be short the out of the money call premium and the out of the money put premium, many times people will evaluate that and say, it's worth it for me to roll that. Always keep in mind, when you're rolling things, you're incurring execution risk, execution costs. You know, there's lots of things that you have to factor into rolling a position around. But if that's the position that you want to have on, oftentimes people will roll it when the actual stock rolls around. The other thing that you need to keep in mind is exercise and assignment. Because if the stock finishes in between these two strikes, between the 80 and the 85, or in between the 90 and the 95 strike, just because you have an out of the money put spread and an out of the money call spread on, it doesn't mean that you don't have exercise risk, assignment risk. Because anytime that you have a position that has short strikes in it, short optionality, and you're trading American style options, you're going to incur some amount of exercise and assignment risk when you're short options. Remember, I said at the beginning of this, oftentimes credit spreads can turn into debit spreads and debit spreads can turn into credit spreads depending on where the stock is. If the stock is trading 88.5 and you're short the 85 put, this is where your exercise and your assignment risk is. Am I going to be assigned on the 85 puts? And if that's the case, you're going to be long stock from 85. The same is true here. If you're short these 90 calls and you get assigned on the 90 calls, you're going to be short stock from 90. Because when you are short options, you have sold that optionality and thus sold the rights that exist with that optionality to someone else. That means when they exercise, your obligation is to make that contract whole. Now, one other thing, the iron butterfly is basically this exact same thing, but with the same strike being the call and the put spread. So in that case, you would have the 80, 85, 90 iron butterfly, and you would be short the 80-85 put spread, and you would be short the 85-90 call spread. The difference between that is if you take this out of this P&L graph and you move this whole thing just over, it's going to look like a V right here, and it'll still have defined risk to the bottom side, but your actual area of potential like positive outcomes is going to be lower. The range of prices is going to be lower, but you're also going to actually, you're probably going to actually take in more premium when you sell it. You would probably sell it for more than $3.05 because that call spread is going to be a little bit more valuable and the put spread is going to be worth a little bit. So that is the balance of everything that I have today. I hope that you've been able to take away something from this. Let's take a look at the chat and see what kind of questions we've got. Jesus. Let's see.
And I'm going to launch a poll in the meantime as you're asking questions, right, Matt?
Yeah, absolutely. Okay, so one of these questions is interesting. Why not just roll the unprofitable leg of the Condor? That's a really interesting question. Why not just roll the unprofitable leg of the Condor? You can do that, and people do that. What you need to understand is if you're just rolling around the unprofitable leg of the Condor, you're changing the actual shape of your P&L graph, and you need to pay attention to where that P&L graph still looks good for you or doesn't look good. Because if you're just moving one set of strikes around, things are going to look much different on the downside than they are on the upside. One of the characteristics of an iron condor or an iron butterfly is that it kind of looks the same on both sides. And if you start to monkey around a little bit with the strikes, you're going to change how your P&L and your risk profile looks, and it's probably not going to be symmetrical in both directions. All right. Do you incur a fee every time you close the position to manage or roll the positions? That's an excellent question. That is a question that you need to have with your brokerage firm because everyone has a different relationship with their brokerage firm. And sometimes your fees are based on how much you trade or in what way you trade or how much is in your account, how much is not in your account. All of those questions are to be had with your brokerage firm. Those are important questions to ask, and they're also important things to build into your model as far as how much does this thing cost me to trade it every time? Because sometimes it's not perfectly free, right? Especially if you're trading 4 options, you need to be building that into how you think about your actual spread trading. Is there a way you can email me the presentation for future reference? Absolutely. If you want to send an email to options@theocc.com, this email address right here, I will send you a PDF of the presentation. Also, anytime that I do presentations, I always post the PDF of the deck on my LinkedIn profile. Afterwards, you can find me on LinkedIn at Matt Cashman. I actually have 1 T in my name, M-A-T, Cashman. You can find me there. And Jesus also posted the presentation. To avoid assignment, can the trader pre-arrange with the broker to close both the short and long positions and thus have a net debit to the trader's account? You can close your position. So here's something that I always say no matter what. The only way to completely take assignment risk off of the table is to not be short options. Meaning, being short a call spread has assignment risk inherent within it, no matter what, if you're trading American style options, unless you close it. And so the answer to this question, can you avoid assignment risk by pre-arranging to close both the short and long positions? The answer is yes. If you want to arrange that with your broker and say, hey, when this iron condor gets down to, a certain price, if it gets down to like a dime or 15 cents or whatever price you decide, I want you to buy it back for me. The answer to that question is yes, you can do that. And that technically is the only way to fully remove all of your assignment risk. The only way to fully remove assignment risk is to close short positions because then you don't have the assignment risk anymore. And if you want to, you can keep the long end on and still maintain the actual long position that gives you the right to exercise. Or if you want to close it as a spread, you can close it as a spread and close both the short leg and the long leg at the same time. So that's a potential as well. What are butterflies? Butterflies are essentially the exact same thing we talked about, but when we talked about the 80-85 put spread and the 90-95 call spread, you notice that those two strikes on the inside have $5 of difference in between them. And that's where that P&L looked like this. It had a plateau at the top of it. That's because there's a difference in those two strikes. A butterfly would be if you just closed that difference and you didn't have any difference between the put spread strikes and the call spread strikes. So that would mean I'm short the 80-85 put spread and I'm short the 85-90 call spread. That would be what we would call an iron butterfly. And the actual P&L chart looks like this instead of like this.
Thank you so much, Matt. I mean, that was a great presentation and great content too.
Absolutely. Thanks for having me, Jesus. I want to remind people, take a look at optionseducation.org. It's a fantastic resource with lots of educational options stuff on it. And then this email, remember, options@theocc.com. You can send us email questions and we respond to every question that we get on a daily basis. We're not registered investment advisors, but we can provide you a bunch of educational resources just like the ones I just did and help you make those decisions on your own when you have a more informed perspective about options.
Thank you so much, Matt. Thank you so much. I'm also sharing a couple of links, that link to the Options Education Center and an article specifically on iron condors and iron butterflies. Our presentation right now, Matt's presentation was recorded, of course. It'll take us a couple days for us to post that on the YouTube channel and on the Education Center. It just has to go through compliance, as you all know, but we'll get it ready for you. And anybody that missed any portions of the presentation can go back and watch the recording. So just stay tuned for that. And that's it. I don't have anything else to add. Do you have any other words, Matt?
No, I think that's it. Jesus, thank you very much for having me. I hope you guys took something away from this. If you need to get in touch with us, you can find us at options@theocc.com.
Thank you, Matt. And make sure you take the poll and answer the questions for future presentations. Thank you, everyone, for joining today. Have a wonderful afternoon and see you next time. Goodbye.